or so I think we'll get started, not to keep everybody waiting. So welcome everybody to tonight's webinar, which is the third in our Make Money, Save Money series that have been really popular. So we're going to be continuing this fortnightly until the end of the year, and we've already secured some fantastic content for you for the next 2 months, which is fantastic. And look forward to presenting that to you. So your support has meant a lot to us, and hope we can share a range of topics that will be of interest for you as you grow your businesses. So thank you very much. To those who are new to our webinar series, this is your first one tonight, welcome. Just a reminder again, just to switch off your audio, that microphone button in the bottom left-hand corner. So tonight, I'm very pleased to welcome Jeremy Little and Anthony Ginsberg, who are co-founders of a corporate advisory firm, Capital Pitch, to provide you with some very useful information about what investors are looking for when they come to choose startups that they wish to fund for the first round of significant external funding known as Series A funding. We're very delighted to have Jeremy on board with us tonight for this webinar. Jeremy's very much an entrepreneurial evangelist, and he's an ally in, I guess, the cause that we're trying to pursue in Australia to really make a more entrepreneurial Australia and really support Australia's entrepreneurs to succeed, to scale, and to really be successful. And we're also delighted that he's able to present some information for you tonight that will really help you and help you take your business to the next level. Jeremy and Anthony are co-founders, as I mentioned, of corporate advisory firm Capital Pitch. In addition, Jeremy does a lot of work behind the scenes at a very high level in terms of policy globally to promote the cause of entrepreneurship, to see where policy can be improved globally in the area of entrepreneurship, especially youth entrepreneurship, and try to bring those learnings to influence the way the Australian government also looks at its policies around this area. And that's something that Startup Australia is also very committed to. It's part of our cause as well. Jeremy is a TEDx speaker. He's also written a book, From Idea to Startup. He started his first entrepreneurial ventures in his 20s and has built some successful businesses. And it's really quite interesting because he's seen from both sides as a successful entrepreneur all the way up to the United Nations level, representing Australia overseas, representing Australia's young entrepreneurs overseas, as well as hosting the Global Entrepreneurship Week initiative, which takes place in the third week of November each year. And that's part of the Global Entrepreneurship Network that Startup Australia, as part of Startup Nations, is part of. So we're very delighted to have him, in our camp, to raise the profile of entrepreneurship in Australia. And hopefully this is now the start of something really significant that we can build together. Welcome Anthony. Anthony is a co-founder of Capital Pitch. He's also a solicitor. He'll be providing all sorts of interesting information on the legal side. So when we do come to the questions and answers, we have him on board. And we'll also welcome Prajin Shi, who is the investor readiness ninja at Capital Pitch. So anything to do with being ready for investment, he's the expert. So we've got some fantastic presenters and panelists on board tonight to support you and answer your questions as well. So Jeremy, welcome, and I'll hand it over to you now to start your presentation. Thank you very much.
Thank you, Miriam, for the great introduction. So I'm going to share my screen. Miriam, is that looking good?
Yep, there it is. Great.
Fantastic. So I'm here tonight to talk to you all about Capital Pitch. Thank you very much for joining the call. Looking forward to answering your questions. We'll run through, and I'll try and get through all this content in about 40 minutes. There's a lot to get through, so I'll run through it as quickly as I can and try to leave that full 15 minutes for Q&A, and then hopefully we'll be able to come back and talk to you all again in the future. So tonight we're talking about Capital Pitch. And we're talking about equity funding insights with a special focus on Series A, and Series A being that first round of funding beyond the seed round, and generally the biggest round of early round of funding for growth capital from early stage investors or sophisticated investors. So at Capital Pitch, we believe entrepreneurial businesses will solve the world's biggest problems, and that by easing the Series A crunch, we enable more innovative businesses to raise capital and grow. So we are the world's first start to finish Series A equity funding platform, and I'll explain what all that means if there's some jargon in there that you don't understand right now. So what I'm going to be running through tonight is a few topics. So here they are: the why and what is the Series A crunch, 3 methods to raise capital for growth, the secret and stages of equity funding, 7 essential elements to be ready for equity investment, defining what investor ready means, the importance of an exit strategy, essential elements of a Series A business, secrets to raising a Series A round, and then why your valuation and this special tool that we've built called the evaluation test is so critical in order to start the journey to raise an equity funding round. So why we exist. And I'm sure that anyone looking to raise capital has experienced what that guy's feeling right now. To take a little step back from just purely raising capital, as Miriam mentioned, I've been working with the G20 Young Entrepreneurs Alliance, with the UN, and the Global Entrepreneurship Week Network now, and some of those organizations for 3 years. And many of them have been designed to address this global youth employment crisis. If you've seen some of the studies around Australia, you'd be aware that the youth unemployment problem's spiraling out of control. So what all of the studies that we did, I co-authored a white paper with the UN last year with a whole range of UN agencies. And what that white paper showed us was that it's high growth entrepreneurial firms that are actually the solution to that problem, because they create 67% of the jobs in our economies. And what other studies that we've done with Ernst & Young and Accenture and McKinsey have shown again and again is that access to capital is the #1 inhibitor of high growth businesses. So this is what we call the Series A crunch, the ability for businesses that are going from 5 or 10 employees and want to scale up. The ability for them to find capital is what we define as the Series A crunch. So what we're seeing is that due to technology and how cheap and easy it is to start a company, there's more and more startups entering. However, there's not more funding available at an equity stage for those businesses. So the competition's getting extremely rough very quickly. And then we see the big VCs, so that the small percentage of venture capital firms that actually make money, particularly the ones in Silicon Valley, their average fund size is getting bigger and bigger, and therefore their average investment size is getting bigger. So there's this crunch that happens with businesses that want to raise between $500,000 and $5 or $10 million. And it's a supply and demand issue. So the problem here is Series A capital is broken, and this is what the Series A crunch is. So what investors see is that 90% of the businesses that approach them aren't investor ready. So the average VC, the average venture capitalist, will not even respond to about 90% of the emails that they get or the proposals that they get from businesses. And of the 10% that they do actually respond to, there's only about 10% of those that they will be interested in investing in. So they'll actually only get to the stage of doing due diligence on about 1%, roughly, sometimes less, of the businesses that approach them. So this is one of the causes of the Series A crunch. And if you look at the data in the US, according to the SEC, only 12% of successful capital raisers use advisors. But what we see is that the businesses that do use advisors are much more likely to raise the capital that they need. Now, to give you a little illustration of this, I used to run a business called Rio Life. This was the one that I founded back in 2004. Now, we grew at 300% year on year for 3 years, and we were up at about 2.4 million revenue and set to go global. And we went to raise our Series A round. And I spent about $4,000 educating myself about how to get investor ready. I spent about $5,000 on a financial model so that I could prove to investors how much our company was worth. I spent another $5,000 on an advisor to put together an information memorandum and a document that we thought would ensure that we could raise money. And then we went out and tried to find investors. And I didn't really have the networks back then. This was about 5 years ago. I didn't know a lot of people that would invest in a fast-moving consumer goods business because we sold health food products through health food stores and pharmacies and supermarkets, Coles and Woolworths. So we searched for money for about 6 months and we overvalued our company. So we thought that our business, based on this incredibly complex financial model that we had produced, we thought our company was worth about $5 million. Investors told us it was actually worth about $1.5 to $2.5 million. And so the mismatch between what we thought we were worth and what investors thought we were worth, and our inability to find more investors to get the proposition in front of, meant that we failed to raise our Series A round. So when we failed to raise that round, it meant that we couldn't invest in new products, we couldn't invest in the sales and marketing strategy to deliver a really solid sales performance through Coles and Woolworths, and it meant that we weren't able to scale into global markets. And what that meant was that all the other businesses that saw how well we were doing and all the media that we were getting instantly wanted to copy us, and we were swamped by competitors, and we didn't have the capital to outgrow them. So it actually ended up causing that business to decline. And that was part of the reason that I left the business, and now 3 years ago. So I left Frio Life with a view that businesses shouldn't have to experience that. They shouldn't have to see a brilliant opportunity die because of lack of access to capital. So that's why I got into the not-for-profit world. And it was what inspired my book. I wanted to try and help businesses take their businesses and to take their ideas and turn them into businesses. And ultimately, over the last 2 years, when I met my co-founder and some of the people we're working with now, we designed the solution to this Series A crunch. And this is what Capital Pitch is. So let me talk a little bit about growth capital for now and the different ways of getting capital for growth before I dive into exactly what the Capital Pitch model is. So there's debt, and most people would know some of the common ways that you can get debt at any stage. So this is when you're really early on, all the way through to when you might be looking for growth capital. And arguably debt becomes extremely difficult. It's difficult from the start, becomes even more difficult to find the amount of money you want at the kind of rates that are affordable when you want big money. So like a couple of $100,000, if not impossible. So credit cards, personal loans, business loans, putting up your house as collateral for a small business loan could be an option, but you'll have a personal guarantee if you take that debt on. So the pros of debt are that you retain the ownership, you retain the equity in the business. The cons are that you're going to have immediate responsibilities. You're going to have payment schedules. You're going to have interest. It's difficult to get in the first place. So if you can get it, then it might be a good option, but you might not be able to get it in the first place if you don't have collateral, if you're really young. There's lots of elements that turn banks away from, as particularly post the global financial crisis. Debt has been extremely difficult to get for banks. And the biggest issue with debt really is that when you want growth capital, so if you want sort of $500,000 and you've got 6 to 12 months of early stage revenue that's growing super fast, a bank will almost never understand why a business like that is viable, because they'll want to see 2 or 3 years of financials, and you probably don't have them if you're a high growth enterprise. So debt is maybe good if you're not looking for super high growth, but if you are, it becomes very difficult. So the next large instrument is equity, and that's selling shares to investors. So equity is good. It's arguably much better for growth companies than debt. And so what equity involves is, and the real key to equity is strategic investors. So you might be able to find investors that come and give you money that add no value to your business, and that's okay. And I'm going to go into this in a little bit more detail later on in the presentation. But the real key to equity funding is finding investors that add value beyond the money. So they might add networks, they might add marketing, they might add the ability to raise more money. There's a whole raft of added value that can come when you raise equity funding. And the final instrument I'm going to talk about, crowdfunding, and it's important to note here that these aren't mutually exclusive. You may use blends of them. There are some equity instruments that are partly debt and then convert to equity, like a convertible note. So these aren't mutually exclusive, but they're just three broad categories. So the third one's crowdfunding. So crowdfunding's new. I'm sure everyone's heard of Kickstarter and how amazing all these new products, these new gizmos that people are inventing are raising all this money by doing basically pre-sales. So that's a rewards-based crowdfunding campaign. That's one of the ways that you can use crowdfunding. There's donations-based crowdfunding, there's loans-based crowdfunding, and what's becoming really prevalent now, which is one of the ways that Capital Pitch raises money for businesses, is equity crowdfunding. So it's actually using the second instrument, but using technology to go out to a broader range of investors and to find the funding from the crowd or from a group of investors in order to raise more money and not have to go to just 3 or 4 sophisticated investors and jump through the hoops that you might need to jump through to raise money from them. So these are the 3 broad instruments. So now let's dive into equity funding and look at what the secrets to equity funding are. So I mentioned that the really key secret to equity funding is finding strategic investors. So this graph that you can see is all the stages of funding and all the different types of funding that you can get based on the stage of business that you're at. And the key thing to focus on as I run you through, I'm going to look at each stage here quickly and talk about the equity instruments in particular, and with a focus on those for each stage. The key thing here is strategic investors. So like I mentioned, they're the people or the institutions that know your industry or know your business path or your stage and can either add value, add growth, add marketing, or find more money, help you get your business to a point where you can raise the next stage and to keep growing. So let's look at pre-seed. So this is before product, generally before revenue, and whilst you're really just at ideation. So generally when you're looking at equity funding at a pre-seed stage, you are super early. And I'm going to later in the presentation talk about defining what investor ready means for each of these stages. So at the pre-seed stage, you're generally looking to friends, family, and fans, or what are often affectionately called friends, fools, and family, the people that believe in you. So the way that you're going to raise money at a pre-seed round, when all you've really got is an idea and maybe some sketches on a piece of paper, a business plan, and maybe some early market validation, the people that are going to give you money at that point are going to believe in you. So they're going to be people that know you or that you can convince in a face-to-face conversation to either lend or invest in your business. So a pre-seed round's normally less than 100,000. That's in Australia. It depends where you are. We would always recommend that people go for as little money as possible. And so if you aren't aware of lean startup methodology, then I'd highly recommend that you buy the book and look up the lean canvas and start looking at that, because using lean startup methodology to spend as little money as possible to build a minimum viable product and then validate that in the market is the best possible way to avoid the misconception that you need to raise hundreds of thousands of dollars immediately to take a product to market. There's lots of really cool ways to create minimum viable products and test them without wasting too much of other people's money, let alone your own money. So generally you want to get as little money as possible and take the cheapest, nastiest version of your product or service to market. And that's the pre-seed round where you start to test your product or service. So the next round is the seed round. I heard some messages come through. I'm not that sure if that's you, Miriam, but I can't see them on the screen that I'm on. So maybe you can talk to me if you need to communicate to me. Otherwise, I'll keep going. So the next round's seed. So a seed round is between 100,000 and at the very upper end, and most likely if you're in the US, about $2 million. And the seed rounds, so the kind of people that you're going to find money from for a seed round, they might be a grant, like a commercialization grant. It could be an incubator or an accelerator. It's most likely going to be angel investors, or if you're really lucky, you might find a seed or early stage venture capital firm, so a VC firm that's willing to put really early stage investment into a company. So at this point, you've got a minimum viable product, you've got a bit of validation, you may just be starting to get revenue. So you'll notice at the beginning of that curve there, some seed stage businesses are pre-revenue, some seed stage are starting to get out of revenue or start to generate their first revenue. And that really would be ideal. If you want to start to raise equity funding, then you should, in an ideal world, depending on the kind of business that you're creating. You know, if you're a medical technology business, then it's a little bit different, or a deep tech play. But in an ideal world, you've got a little bit of revenue before you start going for equity funding at a seed stage. So high net worth individuals are also a place that you're most likely to get money here. And it may not be from highly sophisticated high net worth individuals, whereas at the next stage, they are going to be sophisticated. So then after your seed round, you go to Series A. And so Series A is at the early stage. I grouped them together because some of these instruments work across all three of those rounds. But a Series A round is 500,000 to, in Australia, generally 5 million. If you're in the US, then they stretch up around 10 million. So at this round, particularly for Series A, is where you start to talk to experienced or super angels. So the angels that put in more than the average angel, so maybe up to a couple of $100,000 into a deal, whereas most angels in Australia will be putting sort of 30 to 100 in most deals. Venture capital is really starting to play in Series A, and I'll talk a little bit more about what venture capital is. Corporate venture capital is quite common in this area, but it has different investment goals than traditional venture capital. So again, I'll talk about that in a minute. Family offices, which you can't see on that graph, but are family businesses that have cashed out from previous large businesses, or have made a lot of money and kept it within their family. Now, the secret here is in all three of these rounds is to find the investors that can get you to the next stage. So when you're at seed round, find the guys that can get you here. And when you're at the early stage of the curve here, and you want to get to Series B or C, or to an exit, or to an IPO, and move up to the top of that curve, you want to be finding the investors that can help you get there. So again, that might be across a range of different ways. But it's most likely going to be something that can help you grow, something that validates your model, or creates distribution or marketing, or they are investors that help bring in other investors. So then so Series B and C, and it does go to D and E and F, but I'm not going to go into that because they're mature rounds, and they're just additionally massive raises pre an initial public offering. But Series B and C rounds are normally greater than 5 million, and go right up to 100 million or more. It's generally more institutional investors. So you're talking about the family offices, the private equity, and the larger organizations. It might be private banks as well. And the secret here is you have to find investors that are aligned on your exit strategy. So this is a point that I'm going to talk about more in a minute. But they have to be aligned on your exit strategy. If you're misaligned, if they want something different to you in order to sell the company or IPO it, and most likely the guys that come in Series A or B or C, they're looking for a big exit. They're going to be looking for a 10x return on the valuation that they invest in. So if they invested a $10 million valuation, they're going to be wanting you to get to 100 million, and will probably block the sale of the company until you get there. So being aligned on exit strategy is absolutely essential. And again, I'll talk about that more. So let's talk about the essential elements for equity funding. First of all, customers. You need to validate your product or service. You need to have product market fit. And the way that you do that, or the best way that you can do that, is by having customers. They don't always have to be paying if they're pre-Series A. So if it's a pre-seed or seed round, they don't have to be paying, but you've got to have some customers. And it's way better if they are paying. Exit strategy, as I mentioned, is critical. You need to be able to define your exit strategy and communicate it to investors. If you can't tell an investor how they're going to get their money back out of your company, then they're going to be extremely unlikely to give you any money, because it's a super high risk investment, and ultimately the payoff is when there's an exit. And there's lots of different exits, so again, I'll explain that a little bit more. Now, proprietary technology or intellectual property is another essential element. So investors want to know that you can protect the assets that you're building from competitors seeing what you're doing and just ripping it off. So back to the real life example, protecting a health food is very difficult. So it was very easy for competitors to copy what we were doing, which ended up cutting our lunch and made it difficult for us to innovate and create more niche products. So there wasn't a lot of intellectual property in that style of business, which meant that it was less valuable ultimately. The market size is really important. So equity funders or investors want to see that you're attacking a really big market. So generally, depending on how sophisticated they are, they probably want to see the market size being 100 million or $1 billion or more. Definitely $1 billion if they're Series A or B or C investors, because the market size will impact long-term their ability to create a high value for the company. So scalability is the next one. This is the ability for a company to grow, but for their expenses not to grow at the same rate. So it's the ability, and this is generally achieved by using some sort of technology, not always, but generally systems and processes and technology are the ways that you create scale so that you can massively increase your profit by increasing your sales. The next element is team, and these are in no particular order. Some investors will say team is the most important thing. Some will say that it's different orders. So these are all equally as important for equity funders, depending on what stage they're at. So team is the founders and the experience of the founders in startup before. It's your board of directors, your board of advisors, and the technology or the technical team if you're building some kind of product. That could be designers, it depends what kind of business that you're in. And then the final element here is partnerships. So strategic partnerships are a really great way to leverage your marketing strategy. So investors like to see good brands or big brands that believe in you, that are working with you to help you grow. So let's look at defining what investor ready means. It's been an incredible learning for us at Capital Pitch over the last 2 years to go out to the market and see that there's no real universal definition for what investor ready actually means. It's crazy, but that's part of the reason that businesses have so much trouble. So this is what we've gone to investors. This is what they've told us. We've worked with businesses now. We've had 3 businesses that are raising between $2 and $5 million, and they're starting to have some success. So we know that these definitions are right. So what you've got down on the left here, which you'll see once you do our evaluation test, which I'll talk about at the end of the webinar, you've got a list of documents, and we have a checklist that you get when you complete the evaluation. So these are all the documents. So the evaluation score you get as part of the report. There's an investor deck, which is a 20-slide deck that you would send to an investor once they've shown some interest in your business. Your exec summary is the 3-pager, which is normally the first thing that you'd send to investor cold. A pitch video, which is what we use for funding platforms, and which is really the future of communication. So if you can send a video of yourself talking to an investor, it already sets you ahead of a lot of the game. So it gives them an opportunity to meet you and hear and see what your personality is like, which for a lot of investors is one of the most important factors. A pitch presentation is something that you would use when you're live in a room with investors. So that's about 10 or 15 slides, depending on the length of the pitch. and it's normally more like this with big images and not too many words on each slide. A business plan is a little bit more old school, but good enough to raise a pre-seed or seed round, not so good for a Series A, and I'll explain why in a second. An IM is an information memorandum. So that's about a 30 to 40 page document, really heavy. It's a business plan basically written specifically for a sophisticated investor and for a specific investment round. Then you've got your financials and your legals and due diligence. So this is a full suite of investor communications. This list is basic. If you want to raise equity investment, you're going to need some combination of these documents at a specific level or quality in order to successfully raise your round and really put yourself ahead of the rest of the game. So for a pre-seed round, you're going to need a valuation score greater than 0. So if you take the test and you score 0, then that means you're not ready for equity investment. And that is generally because you don't have an exit strategy, or you're probably a lifestyle business, or you're raising way too little money. So there's a whole range of questions. So there's 14 questions in that test. And when you take that, you've got to score greater than 0 to be ready for equity investment at all. Your investor deck and exec summary. So if you choose to work with us with your funding, if we can help you, then we would, during the end of the phase 2 of our 6-step process, we'd score your documents. And so if the documents score greater than 60%, and you've got a business plan, a decent outline of a business plan, and some basic financials, then you'd be ready for a pre-seed round. For a seed round, you need an evaluation score of around 25. You need the same 2 documents scored above 75%. You need a good business plan. You need some good financials and some basic legals and due diligence done on the business. And then for a Series A round, you need everything. You need it immaculate and scored above 80%, and you need an evaluation score of greater than 75. Now, the reason that the bar gets so high when you go to Series A is because the level of competition for that funding is so much higher. It's so much higher. There's so many businesses looking for such a small pool of money that you have to look absolutely amazing in order to really get the interest of investors. And we've proven this for both for better and for worse. We've taken a couple of businesses to investors that look amazing, and investors are interested, and they start to talk to them and do due diligence and look at investing in them. And we've taken some businesses that were close to this, but not quite at 80% and not quite at an investor ready level for Series A. So they were raising a Series A round of 2 million, but 4 months later, with working with 2 of these businesses, they're still struggling to raise money because they weren't quite there. And investors have picked out exactly what we picked out, or the issues in their business model when we scored their documents. And it's getting those things right that will actually get them to a successful round. So for the first time, we've managed to define this quantify what investor ready actually means, and we've proven that these definitions actually work. So let's jump into exit strategy. Why is it so important? It's important because it shows that you're thinking about investors. When you go to an investor looking for money, it's not about you, it's about what they need and what they want to see. So it shows that you're thinking about how they're going to get a return on their money. Therefore, you're thinking about them. Venture capital is risky. At any stage in a business, investing in an early stage business is incredibly risky. And so an exit strategy is the best way that an investor is going to get their money out. So if you don't know what that looks like, then it's taking something that's already a really risky proposition and making it 100 times riskier. So why would they invest? Alignment equals success. I mentioned before that different investors have different exit strategies. So a big venture capital firm that wants a $100 million to $1 billion exit is going to have certain ideas about what that exit looks like. And if you're thinking, well, I'd be okay with a $50 million exit, and you're not aligned on that when you take that investment, then they will block the sale and they'll make it extremely difficult for you to exit based on what kind of terms you negotiate when you raise money from them. So being aligned on your exit strategy is incredibly important, and defining it and then communicating that in your documents is going to be essential. So what kind of, I'm just going to talk about four types of exit strategy pretty broadly here. And again, like I mentioned before, we've got a lot more content that we can deliver to you, and hopefully we'll get the opportunity to talk to you again to dive into some of this stuff in a little bit more detail. So a strategic acquisition. A strategic acquisition is an exit to a business that can instantly create value by integrating your business into theirs. So maybe they've got a bigger distribution network. Maybe they can add your product to their range of products and instantly times the sales by 10. Maybe they're a publicly listed company, and just simply by playing an arbitrage on valuation, if they buy you at 5 times your revenue and they're valued at 15 times their revenue, then they instantly get an uplift in valuation. So lots of different ways for an acquisition to be strategic. That's often the most likely exit strategy for a startup when they're looking to bring on equity investors. If you're bringing on pre-seed or seed round investors, there's this thing called an off-ramp that they may be looking for. So if they come on at the seed round, they might be happy with a 3 times return, and they might be happy for the Series A investors to buy them out when they raise money, or they might be happy for you as the co-founders to buy them out because maybe they don't want to participate in the next round and they can't add value to the business moving forward. So allowing or trying to create an off-ramp for your early stage investors is actually a really good exit strategy, and really attractive if you can pull that off to the right kind of investor. A management buyout is another one. So the founders may not want to be the executives in the business forever. They might want their executives to take over and buy the company from them. And that might be funded out of profits over a long period of time. They might borrow some money to buy them at a pre-agreed valuation. There's lots of different ways to structure that. Very valid exit strategy. But again, you're going to need to know that any other investors that come on are aligned on that if that's what you're looking at. And finally, the initial public offering, the holy grail, what everyone often thinks is the greatest possible exit strategy. And often it's not. It's a very long-term option. It can take time it always takes time to successfully complete an IPO. It's very expensive, and there's no guarantee, as with any exit strategy. But IPOs can be particularly risky because the fundamentals of the business aren't necessarily what drives the valuation directly after an IPO. There could be market factors, maybe another GFC hits, some other competitor might do something crazy in the market which drives down the value of the whole industry. There's a lot of unknowns there. So whilst it might be the most lucrative if you can get it right, it's super long term and fraught with all sorts of different types of risk. So they're the main types of exit strategy. So what is a Series A business? There's some essential elements which I mentioned before, and some elements that are recommended. So essential is that they're raising somewhere between 500,000 and 10 mil, and that's US or Australian dollars in Australian markets. That's obviously very different if you're in a market like Nigeria, but we're talking about Australia here, so that's for Australian businesses. The business has to be highly scalable. So we're not just talking about scalable to nationally in Australia, most likely. For a Series A business, the investors are going to want to see that you're in about 5 or 10 countries pretty quickly, or at least attacking $1 billion market very quickly, no matter how many countries you expand into. But they're going to want to see that you go outside of Australia for sure. The market size has to be very big, and you must have a planned exit strategy, like I mentioned. Now, recommended, you probably should have customers, and you definitely have to have customers. You probably should have revenue. There's a few exceptions to the rule, which is why we say it's recommended based on the industry, the style of business. You've almost definitely got to have some really good proprietary technology or some intellectual property. There's lots of different types. It doesn't have to be technology, but technology-enabled businesses are definitely far more attractive, and it also plays into that scalability element as well. If you've previously raised capital or you've done a crowdfunding round before, that's a really good sign. That shows that other investors have invested in you, or you've validated your product and proven that you can market it and to successfully raise a crowdfunding round. So that's a really big tick. If you've gone and got investor documents verified by a third party, so third party prepared, or you've worked with someone that's really trusted, then that's another big tick. or if you've graduated from an incubator or an accelerator. And for instance, for us, looking at Series A businesses having come through Startup Australia's training would be a tick. You know, that's you've taken the time to get the education, to take on some learnings, and you've graduated out of a program that's trusted. So, some secrets to raising Series A. How are we doing? A couple of minutes until Q2. So high net worth individuals are individuals that have a lot of money. They may not be sophisticated. So a Series A round, you're probably going to be looking for high net worth individuals. Sophisticated investors they pass a few rules that determine that they've probably got some experience, not necessarily, but they've got a fair bit more money. So they're a different style of investor. So the secret here is identify who you want, why you want them, how they're going to be aligned on exit strategy, and therefore where you might be able to find them. And we've got some tips that we can give once you go through the evaluation test on how to start to identify where you would find these types of investors. Next, you've got venture capitalists, right? So they're a very specific type of investor. They've got, generally, they start at 500,000. Some VCs start at 2 million. Some VCs don't look at investments any smaller than 10 million. So you've got to know who you're looking for and why you're looking for them. And then you've got corporate venture capital. Now, these guys are very different to a traditional venture capital firm. Generally, they're looking to future-proof their business. So they're looking at businesses that might disrupt them in the future, and they're looking to buy them or ultimately acquire them to acquire the intellectual property. They're not really necessarily interested in the financial return. They want to acquire the business to stop them from being disrupted and to bolt it on and grow their own business. So you might want to take VC depending on what your desired exit strategy is. You might not, and you need to be aware of what their interests are before you go and approach them. So when you're looking to identify your Series A investors, you've got to research and list them very strategically. You've got to use your own networks. Investors almost always are influenced by personal networks. If they get a warm lead from someone that they trust, they're much more likely to invest. You've got to raise on your time and know the strengths. You know your own strengths. So if you go out and try to raise money and you're desperate, and your business is going to fall over because if you don't raise it within 3 months, you've pretty much set yourself up for failure before you even start. You need to know how long it's going to take, that it might be a 3 to 6 month process. In most cases, from start to finish, Series A rounds will be about 6 months. You need to be prepared for that. You need to show that in your financial projections, in your cash flow projections. And you need to be able to go to investors and say, I don't need your money, but I'm offering you an opportunity to invest in my business because it's so damn good, you want to be a part of it. That is the way you really want to be when you go to raise a Series A round. And you will need to be an expert. You need to know as much about investment, about raising capital, and of course about your business. You've got to know far more than an investor could ever know. So if you don't know what you're doing when you go to raise Series A, investors will identify that very quickly. So you've got to be an expert. So let's talk about the evaluation tool and valuations in general and why it's critical. Demand for Series A is really high. So you've got to be able to set yourself apart and be above the crowd. You've got to be able to set yourself above the crowd. So competition's fierce. There's a lot of businesses. They're learning a lot. They're taking courses. They're learning about capital raising. They've got really awesome mentors. Maybe they've found some angel investors that are teaching them all this stuff. So if you're going to be ahead of the game, you need to learn. And the US is inflated. So a lot of people will look to the value of their business and compare themselves to US valuations. And they think that that's a good benchmark. It's the worst thing you could possibly do if you want to raise money from investors in Australia. You need to be ultra realistic and if not super pessimistic on what you think your business is valued at. Because if you start low and you build value, then your investors will respect that. If you go out to market with a really high valuation straight away and sometimes some people do it arrogantly or with too much confidence. If you go out like we did and think our business is worth $5 or $10 million and investors know that it's not, then you've shot yourself in the foot before you even start. So if you start low, and this is what our evaluation tool does, once you take the test, you get a report back and it tells you an indicative valuation range for your business based on the questions. So you'll know immediately roughly where you can sit as far as a valuation goes. And then as you learn about how to create an investor-ready business and perfect your proposition, then you build value, and then you can go to investors with a real value proposition. You got to get revenue. So one of the biggest things that the feedback that we constantly give in the evaluation tool and then the investor ready course afterwards is go and get some revenue. It doesn't matter what you're doing. If you can get revenue, that's the biggest thing you can possibly do to build your valuation up. And finally, you got to take the test. So I'm about to show you a link. It takes about 5 to 10 minutes. It's 14 questions. It's super easy. It's the first step. And whether you take the next step beyond that, it doesn't matter. At least we've given you this really awesome test, this great report. It ends up being about 9 pages. And we also send you an investor communications checklist, like I mentioned before. So this is the link here. I believe Miriam will send this around as well to take the evaluation test. As I mentioned, you get the report, the score, and the investor communications checklist. It's all free, no charge for any of this stuff. We built it because we knew that this is what people really needed to get to kick off their capital raising. Just make sure when you go onto the form that you fill up the referrer as Startup Australia and the referrer's email address as Miriam's there. And I think we can, 3 minutes late. Oh, so close. I think we're ready for questions now. Miriam?
Thank you so much, Jeremy. That was fascinating. And I think for anyone who has come onto the call not really understanding it or being quite scared of the prospect of going out and looking for investors, I think that's absolutely clarified it and demystified it. And by creating it a step-by-step process to go through, I think it makes it maybe more achievable. Hopefully some of you will agree that it maybe now makes it a little bit more achievable, which is fantastic. So what I want to do is now just go to Q&A. So at the bottom of your screen, everyone, you'll see a Q&A button. If you do have a question, please type it in, and I will ask Jeremy the questions and he'll answer them live. So feel free to type in a question.
Whatever you've got.
Whatever you've got.
Maybe you've got one or two, Miriam, to kick everyone off.
Yes, I did. I do want to ask, I mean, are there any types of businesses that you think are far more likely to get investment than others? You mentioned technology fueled or, integrated companies and ventures. Is there anything that you're seeing that the trend is moving towards something?
Yeah, definitely. There's some industries that are far more popular than others at the moment. Agricultural technology is really hot, especially in Australia. We're experts at it, and we do it really well. So that the agricultural tech, there's a huge demand. We've got one agri-tech business that we're raising money for, and they started off raising 550,000, and now investors want to put 5 million in. So that's Ag DNA. It's an awesome business, but that's a hot sector. Robotics, medical technology. Look, marketplaces they're still pretty hot. There's a lot of funds that want to put money into marketplaces, but it's super competitive. Everyone's a marketplace these days. Every time I judge a pitching fest, there's about 5 marketplaces out of 10 businesses that pitch, but they're getting investment. So they're the sectors I'd say on financial technology, right? So fintech's the other one that's pretty hot in Australia right now.
I do have a question here in terms of apps. If you have a free app, so it's a download for free, how many users would an investor need to start seeing to take notice of it in terms of valuation based on a free user base?
It's not necessarily about the number. It's really about the growth and coming back. I've seen some freemium models go to Sydney Angels, and the first question they ask is not, some had 100, some had 10,000, and the question is not how many users have you got. The question is how many of them come back, how many of them log back in, and what's your growth rate. So if you might have 100 or 200 users, but if you've grown at 50%, if you've done that in 1 month, or you're growing at 100 users a month for 3 months, it's really about growth and your ability, so your strategy to convert them into revenue. So if you've got 100 users and the potential for revenue is $100 a user every month, then that's a very different proposition to 1,000 users where the potential is 50 cents one off.
What would be the typical return that an investor for Series A round would typically seek?
10x. Generally minimum 10x. A seed round probably 20x. But it also depends on the valuation when you come in and what kind of sector you're in. But ballpark 10x.
Okay, I have a startup here asking, they've got a social economy marketplace that's focused on connecting mainland China to Western merchants. Are they better off looking to Asian investment?
It's focused on connecting mainland Chinese to Western merchants. Yeah, look, the general rule with equity fund is particularly in Silicon Valley, they have this saying that they like to be able to ride their bike between the offices of their investments. And I think that's fairly reflective globally. Is equity investment generally, there's only 2% that's actually invested outside of their own national borders. So raise money from where you're going to operate would be the rule.
I've got one here. How important is it to have a professional, well-crafted offer document?
For Series A, critical. If you're pre-seed or a seed round, not that important. So it really depends on that investor ready definition and what stage you're at. Most investors don't want to see it up front, so there's a strategy and a process as to what information you put in front of investors and when. So if you're cold calling, then they've probably only got 5 minutes for you at best. So an executive summary is enough. If you know them and you've met them, or they've got a little bit more time, then an investor deck is fine, 20 slides. That's not a professional offer document. It should be professionally designed, but it doesn't have to be an information memorandum. And then if they've actually shown real interest and they want to do a bit of DD, then more often than not, almost every time they'll ask for a professional offer document.
If you are looking to get an Australian Series A investor, but you've had pre-seed and seed investment from overseas, is that looked down upon? Would they prefer you to have found that within the Australian market from investors within Australia?
It's not looked down upon. Depends on the investors. As long as you've offered it, if you've offered it to Australian investors and they've said no, then I think, and you've gone and found it overseas, then they'd be like, then you've got a bit of FOMO, right? FOMO is the best. Fear of missing out is the best thing that you can offer to investors, is that they missed out or they might miss out. But Canva's actually a good example of this, right? So Canva raised almost all of its first couple of rounds of funding overseas, and now they're raising money in Australia, but they get to choose to offer the opportunity to investors as opposed to going to investors here with their cap out. So raising money overseas is actually a really good validation that you've got a good business model. Australian investors almost always want to see some customers overseas, particularly at Series A. So if you've got investors and customers overseas and you've got a blend of investors in both markets, then that's awesome. That's exactly the strategy we've approached with Capital Pitch. We've taken investment for our own company from multiple international markets as well as Australian investors. And that just proves even greater validation.
What is your view of the future of equity-based crowdfunding?
Yeah, interesting. I've been looking at policy documents with equity-based crowdfunding for 3 years since the G20 in Mexico. And the Jobs Act is the SEC in the US is only just got its stuff together and started to legislate. And in Australia, I've seen what's happening with policy with KMAC with all that stuff. I think it's a mess. I'm doubtful that the Australian government will get it right. I'm sure they'll do something. They'll almost definitely do something. They've committed to it time and time again. And unless they can't get it through Parliament before, if there's a change of government, would be the only risk to it. So it's definitely going to happen. Our view is that taking investment from the crowd for equity is fraught with a whole hell of risk. like there's all sorts of issues with that from the investor's side, from the retail investor side, as well as for the business. The last thing that you want is 100 retail investors on your shareholder register. That is a nightmare. So we only want to deal with sophisticated investors. That's why we focus on that for Series A. So we don't actually, for us, we don't need equity-based crowdfunding legislation. We operate with sophisticated investors, and our advice to a business would be that you probably only want to do that as well.
This is interesting. So this is from an investor perspective. The question is, I've been asked to invest due to the strategic input that I can offer to grow the company. Is there someone or somewhere I can look up to help validate the investment potential?
Somewhere or someone I can look to help validate the investment potential. Sounds like the kind of role that an advisor would play. I know that there's some corporate advisors that consult to investors to assess business opportunities. If you're trying to assess it based on the value of your strategic input, I'm not sure if that's a question around should the valuation change based on how much value you can add, but yeah, difficult to answer specifically, but if you want to take that offline and email through to Miriam, then we could probably give you a point in the right direction.
I'm not quite, Jason. So I just don't I'll read your question, and it just says regional industry is quite dispersed, but do Israeli, USA, Euro, or Australian professionals prefer particular industry? How many agricultural startups would leave Australia?
Okay, let me answer the second question first. Yeah. A lot, because a lot of startups in general leave Australia because it's a lot easier to raise money in the US and there's a lot more opportunity international. Do they take their whole operation overseas? Not necessarily. Depends on the investors and where they need the people based. Do Australian I'm going to presume that means professional investors prefer particular industries. And definitely specific investors will always choose a specific number of industries to specialize in. Venture capital funds or any particular investor, sophisticated or professional investor, will only generally, or at least the smart ones, only invest in companies where they can add value.
Okay, do we have any other questions? They were great questions. Thanks, everybody. Valerie asked, why is it easier to raise money outside Australia?
So when I say outside Australia, I mean mostly the US and Asia. And I say the US because their capital markets are way more advanced and they get early stage venture capital far better than we do. The investors there are much less risk averse, so they're willing to take risks on early stage businesses. And in Singapore, in Hong Kong, in a lot of the Asian markets, there's a hell of a lot of money. And they really love Australian businesses. So for an Australian business to go and raise money in Asia is a really good option, as long as you've got some sort of network there to help you find the right kind of money and the right kind of investors.
In one of your slides, Jeremy, you mentioned that the US is inflated, I think, in terms of valuation, possibly. Can you explain that a bit in more detail?
Yeah, so I mean, there's just so much money flowing into seed rounds at the moment that the demand supply is the opposite to what it is in Series A. So there's a hell of a lot of supply and actually not enough demand to meet it. So that pushes the valuations up. So the big seed rounds with businesses that have got a scribble on a napkin are raising $2-3 million for a seed round valued at $6 to $10 million. It's crazy. And so what that does is inflate the market. So that's why and that flows into the Series A round a little bit, and is part of the reason for the Series A crunch in the US is because for the seed round investors that have put in money on such high valuations, it means that the next round has to be equally high and equally ridiculous. So you've got Series A rounds that are being valued between 10 and 30 or 40 or $50 million, and it has a flow-on effect. So in comparison, in Australia, our valuations are half or less than half of the US. So our market is probably more realistic compared to the inflated market there.
Will investors be hesitant of untapped markets, as in they may not be proven as yet?
Most likely, yes. Most likely is the answer to that. And the only way to prove it is to get revenue. So you might go into a brand new market and it might not have big players in there already. That's fine. If you can generate revenue, then you prove that the business model is viable.
Okay, I think the last one, this is a nice general one to finish on. What's your view of the Internet of Things and smart home and smart city technologies?
Definitely a growth industry, that's for sure. I think the trick with the Internet of Things is carving out a niche, because there's so many people jumping into it. And I guess the other trick with the Internet of Things is how to apply lean startup methodology so that you're not sinking hundreds of thousands of dollars before you get a minimum viable product to market. So if you can tackle those two problems, then really good industry to get into.
Well, I think that's it for tonight. Thank you so much, Jeremy. That was brilliant.
You're welcome.
I hope that everybody here on the call got value from it. We've recorded this call, so it will be available for all of you to watch back and really take heed. Please head to our website under the resources page. You'll find the evaluation. Please do the test, try it out. Let us know what you think. You'll get your report back. And we'll be sending you some follow-up information on that tomorrow. And as Jeremy said, you know, all the content that was in this could be developed into something more. So if you are keen to find out about this in far more detail, please let us know, because we're responding to your request for information and where we can help you to save money and make money through this series. So if there's more detail that you want on startups, on investment, on the different types of rounds and how it all works, just send me an email and we can create content around that and continue to deliver things. Now, in terms of Capital Pitch, I'm delighted to announce that Startup Australia has teamed up with Capital Pitch so that we can now start to offer this Series A round, this information, this education to our members so that you can scale your businesses and grow. So we'll be providing you with some more information on that as well going forward. Tomorrow you'll receive an email from us with the video, with the links, and please let us know what you're doing after the last few calls. I've had some fantastic conversations with our members, people emailing me to let me know what they're up to and get some advice. So please, email us. We're here. We've got a group of entrepreneurs, some of them Australia's leading entrepreneurs, who are on board to support you and to answer your questions, hopefully open up their networks as well. So tap into it. We're getting some really great entrepreneurs with great initiatives sending us emails. So be one of those and we'll see if we can help you. So thank you very much to Jeremy, Anthony and Prajin. The brains trust weren't needed because you obviously answered the question so well, Jeremy. So thanks again, and good night, everybody. And thank you very much for being on this call. We really appreciate it. Thank you.
Thanks, Miriam.
Thank you so much, Jeremy. Okay, good night, everyone.